Well, the way I read it was the Fed's going to raise rates 75 basis points. There's no question they're going to keep going. You're printing an inflation CPI number of over 8%. What no one knows, though, is how much of this inflation is caused by supply chain issues. Because, I've got a pretty good lens on supply chain issues. I have 54 private companies in our portfolio, everything from gym equipment to greeting cards, commercial kitchens, wireless charging, you name it, we're involved. And when we talk to the CEOs of these companies, they're still having a really hard time. Let's just take the gym equipment company in Fargo, North Dakota. We used to get our metal from Asia. We can't get it anymore. We can't get it through the port in Los Angeles. We have to make the barbells and all the gym equipment in the US, cost 30% more. We pass the price on to the consumers. They're still buying it. And that's inflation. Now, as soon as we get the supply chain thing worked out, we'll be dropping prices, but we haven't been able to get it worked out yet. So I think half the inflation, frankly, from my point of view, it hasn't worked yet. I'll tell you something very interesting about this cycle. And of course, every recession has a different tone to it. We get tear sheets every Tuesday morning on revenue and free cash flow from most of our companies. So we get a pretty good read on a weekly basis. And so far, and this is kind of interesting, no slowdown yet, no slowdown. And these are consumer goods and services. So we have not seen a slowdown. And the reason we care about this data is we're trying to make a decision, excuse me, on what we're going to do with inventory going into holiday in the US. We've got a $110 million decision to make in the next week. Do we build inventory with the assumption that demand remains constant, or do we feel in Q4 that demand will pull back because the Fed's raised rates? And so we've made the decision we're going to go balls to the wall, build out for Q4. We don't see the recession in the next few months. We think it happens next year, but we don't know. And this is the same consideration that every company's trying to make. At what point do
Yeah.
they indicate that they're going to stop? Because another 75 basis points already anticipated in the 2-year. You're about 4.5% on 24-month money. The stock market is fibrillating. It's having a lot of volatility. The VIX is trying to figure out the moment the Fed pauses. And so this is the interesting challenge. I don't care if you're in crypto, your equities, or bonds. What happens in these cycles, and this is always a challenge, and we have a good example in recent times, 2020, in the middle of pandemic, total chaos around the world and the markets. The stock market actually did quite well because there was all this QE coming into it, this quantitative support, and the Fed printing money. But all of the returns, 95% of the returns came in basically 18 trading sessions, 18 8-hour periods, where you had that volatility, 2,000 points up, 2,000 points down. You just didn't know which day those up days occurred. And so if you were trying to time the market, it might happen that way. But let me suggest a different reason to start going long Bitcoin, which has nothing to do with foreign currencies, but a lot to do with policy in the United States. There's two bills floating around, but let's talk about the one that has the chance of actually getting passed in the US after November 8th, which is the midterm elections. It almost went to markup last week. It's called the Stablecoin Transparency Act. Now, this has nothing to do with Bitcoin, but it has a lot to do with the tone of regulation. And the reason I think it's interesting is they're trying to solve for the challenges that occurred in these collapses of stable coins that were built around algorithms. 62 billion got erased. The regulators got upset about that, although the majority of that capital, because it was decentralized, was in other countries. But this act is very simple in nature, which is why it may pass. It's being supported by both parties. And the reason that's the case is that it makes effectively the US dollar the default payment system worldwide. There's another reason as well. 45 days ago, you could take and you could lend or stake your USDC within your wallet. Let's say you had a wallet at Circle. You were making 3.8 to 5.2% for 30-day or 6-month or 1-year contracts. That was the spread. And you were putting that out very easily on their platform. Today, the only interest you can make is 50 basis points. And you're looking at 2-year treasuries at 4.5%, there's no competition. Part of the challenge USDC has is it wants to get regulated so it can act as a sweep account and start to be competitive against bank accounts that are offering 1.5, 2% interest rates. So you have no incentive to keep your stable coin in your wallet. you're transferring back to US dollar and parking it back in a fiat currency where you can get risk-free, basically a treasury bill for 24 months, 4.5%. His stock, along with other bank stocks last week, hit new 52-week lows. Part of that challenge is this concept of the Stablecoin Act being passed, and that specifically hurts him on ACH transfers and wire transfer fees, which are very high between banks, particularly across economic geographies. So if you're transferring from US dollar to Swiss franc through an ACH, you're going to pay a lot of fees, and you pay a lot on the SWIFT transfer as well. And those banks make millions of dollars each quarter off those fees. If all of a sudden you were allowed to use a stable coin at a fraction of that cost, and both regulators allowed for that transfer, that would really hurt profits in banks, not just JP Morgan. And so you're seeing a lot of that issue right now in the equity values. You would think as rates go up, these bank stocks would be moving north. No, they're hitting new 52-week lows. And part of this is the market trying to anticipate the disruption when it's going to happen. Here's a question for every investor to think about. There's a risk in investing in Bitcoin and all crypto. No, we're constantly rebalancing as we do at the end of every 30-day cycle. We look at our positions, not just in Bitcoin and crypto, but across the portfolio. Fixed income has been as challenging as stocks. They've gone down just as much in the last 18 months. So it's been a very difficult time for every asset class. Regarding Bitcoin, though, our own operating procedure, we can't own more than 5% of the operating fund in Bitcoin. So we also have positions in ETH and Solana and all kinds of other, we're just looking at putting a position on in Pollen and Helium, which are really eclectic projects around decentralizing telco. But the whole point of this is that you just simply don't know when these asset classes are going to move. I have a personal speculation around regulation. I talked about that earlier, that if the Stablecoin Act gets put into law, that will be a signal that all crypto will be regulated at some point. Some people feel good about regulation, others don't. But here's a fact to consider regardless of your position. Most of the sovereign wealth funds that I work for as an indexer, so you have to be voting and cheering on regulation. You put $1 trillion into Bitcoin, that's when you might see it at $60,000 to $100,000 valuation. And those funds don't care. Once they index it, they're the automatic bid when it dips below the 50 basis points or 1% they've decided to own, and they sell into strength. So there's a really, really liquid market about to happen. That's very optimistic for Bitcoin, not pessimistic. I really don't understand when people say, oh, I hate regulation and decentralized asset. You want regulation because that's where the money is. Actually, where you see it manifesting itself, because I'm very involved in the fixed income market, single B, double B, triple B, investment grade and above, right to treasuries. I'm a balance sheet guy. I've been a bond trader my whole professional life. There's no liquidity now in commercial real estate loans. The banks have completely stopped lending. And that's very unusual because they're trying to figure out where the cap rates are. And it's very simple. Most people assumed in the US economy, and it's the same in Europe and in Asia, that 15% of office workers would not return to the office space. AAA office tower in Boston is a good example. It was trading at a 4.6 cap. Now, when cap rates go up, it means things are less valuable. Today, what they found out, let's take law firms, 55% are not returning. So they've grown used to living with, their families in better locations, near better schools, or taking care of elderly patients and parents. And so you've got a real situation where AAA office and warehouse and commercial and shopping malls and all of that are being revalued lower.